Good morning, everybody. It's Thursday, February 15th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll get to that during the show. Quickly here, overnight markets had March corn down 1.5 pennies at 4.22 3/4. March soybeans were down 3 1/4 at 11.67 1/4, and March Chicago wheat was down 9.5 at 5.76. A lot of stuff to get to here this morning. Weekly export sales were out solid for corn, a little over 1.3 million. The upper end of the estimates were looking for about 1.5. So a good week for corn. Soybeans fell at the lower end of the estimates at 353,800, and wheat was 349,300. So kind of lower end of the range there for wheat. This morning, USDA Outlook Forum was out. I know we're going to talk about those numbers here in just a minute. And the crop insurance pricing window is closing here pretty quick. We're halfway through. 10 days priced out of 20. The corn price right now currently $4.73. Beans are $11.70. So we'll jump right in here this morning, fellas. Just a quick rundown. The USDA Outlook Forum, historically not a real big market event, if you will, but it seems like in this environment that we're in here today, people are certainly talking quite a bit about it here this morning. They had corn planted acres, 91.8 million, with a yield of 180.4. For soybeans, they're at 87.5 million acres with a yield of 51.7. And wheat came in at 47.5 million acres with a yield of 49.2. So we'll jump right into it here, guys. What stood out the most to us, and what do we think this means as we continue through, obviously, the end of February and into ultimately the most important upcoming end of March planning intentions report. So I'll kick it over to Justin for some thoughts to start this morning.
Yeah, thanks, Dan. Like we were talking this morning, I mean, usually this is it's a nothing report. It's a 10-year outlook that's rarely right. I mean, if you look at where we end up versus what they project. So I think just because of the tough conditions that we're seeing, the market kind of falling apart a little counter seasonally. I think a lot of people have been talking about it, going into this report, and I can't remember a time that was the case. So, it's the numbers they put down. I think if anything, Dustin brought this up. I think the yields were probably smaller than people were thinking as far as this report. And that's probably the most important number to look at, just because it's most likely the trend that they'll use for the S&Ds this summer to start until we start getting into actual crop conditions or anything like that. So, other than that, the market just feels like it's, a lot of talk about, prices continuing to break, profitability, completely leaving for new crop, old crop, basis only contracts. As we've been talking about, we're going into another first notice A type period where they're going to have to, either roll their long, the grower that's unpriced on those basis contracts, or price them. So I think the market's really caught on to this issue, right? We've been talking about it for a long time. The inherent risk of these basis only contracts on high risk, or in a high carry out environment and a high interest rate environment. And I think those factors and flat price breaking, it's, really taking a lot of energy out of those longs, the farmer longs. So I think that's what the market's kind of keyed on here, until we clean up that position somewhat. It just seems like it's having a really hard time sustaining any kind of a rally. That's what I see. I don't know about you guys. I mean, we haven't really broken to enough demand to turn it around. We don't have enough of any stories today to really turn that momentum down. And it feels like it's all kind of keyed on that long farmer position.
Yeah, I'd agree with that. So, last year, for example, our trendline USDA yield, we were using 181.5 coming into the May WASDE report off of the outlook numbers. And so for them to put out, what was it, the 180.4, obviously shows a change of direction of the exponential rising trendline yield the USDA wants to start off using. So for a long time, like if you just took a standard linear trend line yield, it was typically coming in well under what the USDA was using going into the May WASDE and the Fed outlook. And the USDA had been right for a long time, right? Like we were rising at a much faster pace than the trend line was calling for prior to that. In the last 4 or 5 years, I think there's been a lot of question, about whether or not that trend line is slowing. I mean, we've been, 167 to 176, back to 173. Last year's 177. So last year we hit a record 177.7 is our January number in the end. But if they were going to continue on the same path that they were going before, rising from 181.5, that would have been, I think, again, a lot of question from the private market. So it does help it does help solve for an excessive balance sheet right away in May. And it's not like the market really cares what the USDA economist thinks, but I do think that the imagination of a very large balance sheet, it is not going to be just like as blatant. The conversation around should that yield continue to be rising is in question. So if anything, I think that it's a little surprising to see them come out with that number, and I think it might help make that realization in May.
Yeah, and to that point, it's hard to. I know it's mentally hard for people to start off with a trend yield that's 3 bushels above a record, right? As like a starting point. And, so we're going to, there's a chance we'll see some of the biggest carryout numbers. And that's just, we have so much time ahead of us, that we still have to get the acres. A lot of people are talking it's going to be 92 or 93. Obviously, we don't necessarily agree with that from what we're seeing. A 180 plus corn yield, for example, 51.7 beans. We've got a long time ahead of us. I know that some of the weather guys that we really like are, kind of starting to put out their forecast for spring and summer, and there could be some switches from El Nino to La Nina, and so there's just a lot of things that have to happen, and I think that's why we're in this. I don't think the market's focusing on all things that could go wrong right now. It's all the things that are wrong with too much corn, and I think that's all the market's focusing on right now. That's all because it's it's such a position that's lost a lot of money.
Well, that's a great point, Justin. We talk a lot about throwing things at the market. I mean, if you look at new crop corn and beans, you could argue that you have literally thrown almost everything you can at these two commodities. And, I guess, glass half full, but, you're still over 450 or 462 today in new crop corn. I mean, that's with a lot of, probably the most negative stuff you can throw at it being lobbed, right?
Well, I think for today's date, you still have to grow the safrinha crop.
Yep.
For one, which is a huge crop in corn. You still have to plant our crops. You still have to, all these things still have to happen. So if they all go right, if we do end up with a big safrinha crop, if we do end up with 92 million corn acres and a 180 yield, yeah, we'll probably be 350 corn by next fall, right? But there's, a lot that has to happen to get to that position.
Yeah. The other thing too is, again, going back to that trend line yield, going 2003 to 2023, that the linear trend line comes in at 179.28. So I think linear trend is probably a better use rate as of right now, as far as like what are our chances of being 5% above or 5% below, right? Usually that's where we stick in that window, within a 5% window. And to your point, we still don't have acknowledgement yet of what safrinha corn is going to be. And I still go back to like, okay, 350 corn, if that's where it needs to go because we're in excessive supply, that would make sense. But what can demand handle too at the same time? Because at some point you're not going to incentivize enough corn production globally if our inputs can't start coming back down. So I'm still of the camp that perhaps the fact that the last 3-4 years, we've experienced over 20% inflation from where we started prior to that. And it's due to the fact that we have a much higher monetary base. Inflation is historically very hard to come down. Input cost inflation is real as well. And so I do think it's just going to be a bit difficult for mean reversion to go back down substantially into, that double payment territory of both farm bill and crop insurance. In fact, balance sheets probably look better with everything we already have so far, being at this date, being halfway through the crop insurance setting date. They probably look a lot better at $3 corn than they do at $4 corn because of the safety nets. So we got to start to think about, like, how far down do we need to have, kind of gap coverage from where we stand today down to where these safety nets kick in. That's kind of where our marketing focus is shifting to be more efficient. And then, how quickly do we need to get aggressive selling if we get your typical spring rally, into a seasonal. So, it's not going to be an easy year like the last couple of years where we can just pencil a margin and pull the trigger. There's going to be a lot of work. Sharpen your pencil, like you said yesterday. But, I think that it's not all doom and gloom either. So.
No, all good points. I think everybody took a big deep breath when you brought up the lower prices there, certainly, Dustin. But I think you highlight a great point, and that's with all of these different tools and farm programs, and certainly, I'm sure most folks are starting to at least entertain the thought of purchasing the crop insurance and what policy they're looking at. But looking at that in a matrix, everything together, is going to be uber important as we go into the, before planting, just to understand, you mentioned it a lot, plan A, plan B, is what is going to be your next move, because it's, all the chips are on the table for a lot of folks in terms of, making this thing work if you get the opportunity, right?
Yeah, play to your comparative advantages is one thing we usually say. And farm bill, whether you're choosing Art County or PLC, farm bill does have some safety nets built in, especially below $4 marketing year averages. Crop insurance is halfway set as of yesterday, so it can only move so far. Your guarantee can only go down so much over the next 10 days of business days through the month. So we're starting to carve out some things that are at least, setting a base for the year, albeit it is at a negative margin for the average grower. So, we just go back to what can demand stand for, and then watch for any problems in Safrina, hopefully to give us some chances in April and May. That's really our seasonal timeframe anyway. So I don't know. It's hard to predict the future of what's going to happen. But we at least know we can box in certain scenarios around what we already have in place: farm bill, crop insurance, and any plan B hedging that we've already engaged in or plan on engaging in prior to the end of the seasonal. And then let the chips fall where they may at that point, right? Because it still always has an equal chance of having a poor weather situation, or the demand side still needs the corn regardless. And so I don't want to write off the year just because we're coming in on kind of a negative note that it's set in stone. We're going to have a bear market year.
Yeah. And just Dustin, to that point, at least since I've started, so 20 whatever years now, somebody told me the market always gives you at least one chance, at profitable levels. And that's always been the case. It might be 7 days long. Mm-hmm. We saw that, I think you mentioned this yesterday, that 15, 16, 17, it felt like every year you'd have like a 2-week rally. But there was always an opportunity at some point. Usually it's the hardest one to make because it's right. There's a reason that it just had that big rally, but whether, who knows what that rally could be. It might be 30 cents. It might be $1. But usually the rally's a lot more violent and quicker than people think, especially when everyone's kind of leaning one way. But to your point, I think that's why you have to be prepared for whatever that is, whatever those levels are that you need to hit, those targets or whatever, you have to be prepared. So if it does happen, you can take advantage of it. Too many times we see that and then people say, well, let's see how this thing plays out. And how it plays out is it goes right back down. more often than not, especially when you're coming in with a lot of headwinds. The last 2 years you had a lot of tailwinds, right? You had global supplies were kind of depleted, so you had to kind of prove a good yield, and now we have to kind of prove a problem. And yes, Kyle, pulling the trigger is the hardest thing. Absolutely. But if you know where those numbers are and you kind of have that plan, that's really going to help, in my opinion.
No, really good stuff, guys. We just coming into the open here. March corn down 1/2, 423 3/4. March soybeans down 4.5, 1165 3/4. And March Chicago wheat's down 10 1/4 now, 575. A couple of administrative things to point out here today. Just to let everybody know, markets will be closed during the day on Monday for the holiday, and we will reopen Monday night at 7:00 Central. So mark that down if you don't see any markets Monday morning. The war room will also not be taking place on Monday. We'll be back with you on Tuesday there to start next week. Jack will be in tomorrow morning to host the show. So you get a little Jack the marketing guy tomorrow. So that should be fun. And as always, we are streaming live on X, Facebook Live, and YouTube Live every day that the markets are open, 8:15 Central Time. Appreciate everybody tuning in this morning. Thanks to the guys for the thoughts and comments this morning. That was a good discussion. Hope everybody has a great day, and we look forward to talking to you soon. Thanks.
Thanks, Dan.